Look at me, Captain Phillips. This is important. The conventional wisdom in investing is to buy and hold, buy the dip, invest for the long term. But what if this is actually wrong? For instance, the stock market is currently down about 13%. If you sold at that point in March 2020, you'd have saved yourself from falling another 27%. In this video, I'm going to be taking an unbiased look on whether it makes sense to sell all of your investments before a market crash. Back in the day, way back in the day, most new investors commonly met with financial advisors. An important thing an advisor would do is walk their client through a checklist to make sure they were ready and willing to invest. Are you financially stable? Do you need this money in the next 5 years? And perhaps most relevant, how comfortable are you with risk? How comfortable am I with risk? Well, I think very comfortable. I'd like to earn as much as I possibly can.
That's all well and good, my friend, but please do tell me, how would you feel if your investments lost half their value?
With the proliferation of zero-cost investing apps, many newcomers entered the wild world of the stock market last year with big expectations. But they did so on their own, no financial advisor. However, I'll be the first one to admit that in general, there are many cases where financial advisors actually provide negative value, mainly because they tend to underperform and charge high fees for it. But if there's any good that they bring that's relevant to today's video, it's conducting a proper risk assessment. How many of you who recently started investing have done a risk assessment or even know what one is? Well, not to call you out, but here's your wake-up call. And fortunately for you, we can do a basic one in real time today. A conservative investor generally allocates something like 25% of their portfolio to stocks. The rest would be in safer investments. Moderate would be 50% stocks, aggressive 75%, and then we have all stocks at the highest risk. But what does that actually mean? Well, let me show you. I've just run an analysis here going all the way back to 1987, and what we're looking at is a comparison between portfolios with different mixes of stocks and bonds. A portfolio with more stocks is generally going to be more risky. So look at the max drawdown here. This is important. For the riskiest portfolio with 100% stocks, your biggest drawdown was 50%. For a slightly less risky portfolio with only 75% stocks, it was much lower at 39%. And then finally, with the lowest risk portfolio here, you can see the drawdown was much, much smaller. So if an investor puts 100% of their portfolio in stocks, not even to mention crypto, you are implicitly agreeing to potentially experience a drop of 50% or more. So the S&P is only down about 13% at the time of this recording, and the NASDAQ is down about 22%. How are you feeling? If you feel anything less than fine, it might be a good idea to reassess your risk tolerance. This size of drop in the S&P 500 is actually the average drop that has happened every year since 1950. However, if this type of drop is normal, then what is abnormal? A 5% drop is super common. 10% happens most years. A 20% drop is where we start to get into the rare territory, and anything beyond that becomes very, very rare. So, using simple probabilities, we could say, an investor could sell everything in their portfolio and take a loss today. Say something like a 13 to 22% loss just going off of the S&P and the NASDAQ for simplicity's sake. And in return for that loss, they are protecting themselves from a 5 to 26% chance that the market falls further. Put another way, that investor would be making this decision, taking that loss with 74 to 95% chance odds that that decision would be a mistake. Now, I'm not here to tell anyone what to do. In fact, I actually can't. But for me personally, that would be pretty stupid. That is a terrible trade-off from my perspective and is totally misaligned with my risk tolerance and my goals. However, in order to be able to make clear and good decisions, I think it's very important to have a very clear and thorough understanding of your own risk tolerance and financial goals. Although you could say because of multiple negative catalysts such as sky-high valuations, sky-high inflation leading to aggressive monetary tightening, withdrawal of liquidity, and ultimately a big rug pull by Daddy Powell. These maybe justify a higher probability that the market goes lower. Sure, I think that's actually reasonable to say. But because we can't know for sure, my personal preference is to raise cash to go on a potential shopping spree instead of selling and crystallizing a loss now in front of a potential further drop. We've been tracking all the market developments on the channel over the past while, going all the way back to last November, pretty accurately so far, and it's no accident that I've been moving more and more cash into my portfolio. So, as Jeff Bezos recently said, the market teaches, and perhaps this is a good time to learn more about what risk really means in the context of the markets. I did make a video on how to do a risk assessment a while ago. It's a bit of an older video, but should still prove of use. Click the card in the corner to check it out. And if you're new here and would like to see how I'm personally navigating the markets, please go ahead and subscribe. I think we have a lot to talk about. Thanks for watching. Take care.